Hey everyone, thanks for tuning in for another video that we record here at Eureka Business Group. This one is going to be a quick one about multifamily valuations. So how do we determine the value, the price for a multifamily property? My email is joseph@EBG Texas. If after the presentation you have a few questions you want to ask, another clarification, just shoot me an email. So we start with the formula. And the multifamily value is determined by NOI divided by cap rate. NOI stands for net operating income, and we divide that value, that's dollars, in cap rate, which is a percentage, and that is very specific to that submarket of the property, and that gives us the value. Now, this is a mathematical equation, so we can always determine the value of one parameter based on the other two. So if we want to know the cap rate, we just need the NOI and the value. So let's break it down and see how it looks like. So breaking down the formula, we start with NOI. NOI stands for net operating income. And to get the NOI of a property, it's a very simple calculation of total operating income less total operating expenses. And on the operating income, we put in anything that is generating revenue to the property. So rent, obviously, laundry income, administrative fee like application fee, pet rents, vending machine income, utility chargebacks, also known as RUBS, and every other really revenue stream that the property has. And multifamily owners are notorious for finding alternative revenue streams for their properties. On the operating expenses side of things, we find the staff salaries like the on-site manager and the maintenance people, the leasing agents. We also include the repairs and maintenance we did all year, so all the parts, all the expenses, permits, and so on that we had to pull. Utility bills is also a big chunk of our operating expenses. The water bills, the electricity bills for the exterior lighting. Some properties are all bills paid, so that is included in there as well. Property taxes is one of the major expenses most properties have out there. Insurance, obviously, administrative and marketing and advertising. These are all buckets that we put things like Facebook ads and circulars and brochures and CPA costs and all these things. So let's take a look at an example of how we calculate net operating income. So for example, our annual rent from a property is $1,000,000, and then laundry income is $10,000, and utility chargebacks rack up $140,000 in revenue. And then total everything else brings, let's say, another $50,000. So the total income we get from the property is $1.2 million. On their operating expenses, and these are all made up numbers, right, just for the sake of the example. So let's say we pay $70,000 in salaries and $300,000 in repairs and maintenance, another $80,000 for the utility bills, and property taxes is another $55,000. Insurance at $30,000, advertising at $10,000, and admin at $5,000. That total expense comes into $540,000. So when we use our formula of operating income less operating expenses, what we get is $1,200,000 less $550,000. So this specific example property is going to have an NOI, net operating income, of $650,000. So moving on to the other part of the formula, the cap rate, right? So by definition, the capitalization rate is the rate of return on a real estate investment property based on the income that this property is expected to generate. The capitalization rate is used to estimate the investor's potential return on his or her investment. What does it really mean? That was the definition. Well, we use cap rate to compare properties based on their NOI and asking price. So if I have a property that brings in $500,000 in net operating income per year and it's sold for $4,000,000, then the traded cap rate is 500,000 divided by 4 million, which is 12.5%. Well, that was easy enough because the numbers are really nice and round. But if I have to compare it to the property in example 2 that has a $357,000, 231 as NOI, and it was sold for 2,312,650. It's really hard to compare apples to apples because these numbers are not round and nice like the ones in example 1. So when we pull the formula out of this and we do the division, what we get is a cap rate of 15.44. So obviously the property in example 2 was a better cap rate than the first one. But without doing the calculation and comparing apples to apples, it was really hard to understand which one was the better deal. So what can impact our cap rate, right? So economy condition is one of the main factors that impacts cap rate, right? So when the bank rates are low and the banks are more free with the lending restrictions, right? They want to lend money out. Then the cap rates tend to compress, go down. And because of the inverse ratio between cap rate and value, cap rates going down means value going up. And then the reason it's compressing is because there's oversupply of money. So people get an easier loan. It's a lot easier to get money and buy properties, which increases the competition. And that's the reason number 2 that we have up there to impact the cap rate, and that's supply and demand. If there is oversupply of a specific asset type, let's say office or retail, then the cap rate of these properties really expands because there is too much of the property and the value of the properties go down. And then the third thing is the submarket environment, right? So the first one was economic conditions, which is the macro. Submarket environment is the micro. And if we have a specific city or a zip code that have bad elements move into it, this will impact the values of all the properties in the neighborhood. And then if the value goes down, cap rate goes up because it's an inverse relationship. So I can't really emphasize that enough, that cap rate is working in the opposite direction of the property value. So the higher the cap rate, the lower the value of the property. And then the lower the cap rate, the higher the property value. That's the math of the inverse in the division. So let's try to put this all together into one final calculation. And in example 1, we're trying to find the cap rate of a property. So we know the operating income is $5,000 and the operating expenses is $2,300 and the asking price is $800,000. So to calculate the cap rate, we do 5,000 less 2,300 divided by 800,000. That's a 0.3 cap rate. That's probably a California property. And the reason I chose low numbers like 5,000 and 2,300 is to show you that it works in every level of numbers that we choose to. And then in example number 2 is trying to valuate a property. What's the price we should pay for this property? And this is what this is all about, right? This presentation. So if I have an operating income of $750,400 a year and my operating expenses are $352,700, the area cap rate fluctuate between 6.5% and 7.5%. This means cap rate can be also a little bit fluid. It also goes to supply and demand. It also goes to seller's expectation. If I'm a seller, I want the lowest cap rate possible, right? But if I'm a buyer, I want the highest cap rate possible. So it's 6.5% cap rate, right? If we do the NOI divided by cap rate, this property is $6,118,461. And if we do the cap rate at 7.5%, it's about $5.3 million. So really, when we look at the conditions, right, we know the NOI, we know the area cap rate range, then we can put the property value in between $5.3 and $6.2 million. And this is how really we evaluate a property when we don't know an asking price. We look at the NOI, we look at the immediate submarket cap rate, and that's how we evaluate the property. So this is it. I'd like